Thanks for joining us, everybody. We're going to do a little bit of a presentation on where we think the markets are going. Craig's going to cover it from a few factors, specifically concerning the whole inflation thing and a few other factors. So once we've gone through that, then I'm going to go through the questions that I received on the blog. Now, I did mention to people that we're going to record this, and I will post the recording. So I think a lot of people will also be waiting for this recording. So we'll get whatever participants we have here today, and then we'll we'll answer questions on the chat box as we go through the other questions, and then you guys can watch this after and pass this on to friends or whatever. So I've just got to admit, I'll be admitting people into the meeting as time goes on. Usually we get a few people that come in a few minutes after the video starts. So I'm going to just get started with the presentation now, and then we'll get right into the questions. You'll be seeing me refer to this sheet of paper, which is where I've got the questions, and I've done some scratch notes. I am going to be share screening a lot, being the technical guy. And so as I answer the questions, I'll bring up charts to illustrate the points that I want to make about the questions. And by the way, some of these questions were just excellent. Really, actually very excited to answer some of them. One person even asked a question that is going to be directly addressed in my course that I've been working on. But I'll kind of give some input on, because I've just been working on putting those thoughts together for the course. So it's going to be great. So, and Craig is online, I can see. So let's just get started. And just FYI, I have this cup that my wife gave me, so everybody can see that, even though we're doing this by video, we're properly dressed. All right, so let's get started with the presentation, and it's just a very quick, because I really want to get right to the actual nuts and bolts of it. So I just have to slideshow, start from the beginning. Okay, so this is basically a very basic market outlook, and you can refer to the blog because some of this stuff I cover a little bit more in the blog. And then we've got some other thoughts that Craig has specifically surrounding inflation, like I mentioned. The standard disclaimer, you guys have seen this before, but really this kind of presentation is not investment advice. You can't trade off of this stuff. You shouldn't trade off of this stuff because the markets are fluid. We just look at the markets at any given moment, and it's our opinion. So it's myself and Craig's, and that's all it is. So I'm going to start off. I just posted the barometer, which is something I do at the beginning of every month. And a lot of you that follow the blog regularly will know that it's a risk-reward scale. It measures trend, it measures breadth, it measures breadth momentum, sentiment, seasonality, valuations, all kinds of stuff. So it puts it into a point system. Sometimes you get negative points, sometimes you get positive points. It's not really a great market timing vehicle per se, because it gives us an indication of the relative risk, and that's not something you can trade off of. However, having said that, Craig and I do use this to adjust our cash and make ourselves aware of the environment. So the past number of months, really most of the summer, it's kind of hovered around 4, which is right in the middle, neutral. But just this past reading, which was done on Monday of this week, it moved to a 3. Now, 3 is kind of that barrier between, is it kind of getting into a higher risk environment, or is it still neutral? You can almost, it's the wishy-washy zone. 3 and 5 are wishy-washy, but it's leaning to get, you can see the trend has been, because it was 5 just a couple months ago and it went to 4, and now it's gone to 3. So the trend is getting a little bit more risky, and where that risk is coming from on the barometer really was a couple of factors, but the one that subtracted a point this month was the smart money, dumb money indicator, which is really just measuring options activities, trading activities, that kind of thing from the so-called smart money, from pension managers, commercial hedgers is a big factor. So sentiment trader looks at their trading activity. You can see the big trades versus the little trades. Then they look at what's called dumb money, and that's really just retail investors, you and I, and how we track that is through mutual fund flow and ETF flow, because mutual funds aren't so popular anymore, but ETFs are, and ETFs are the chosen investment of retail investors in many cases. You won't see a giant pension plan trading ETFs. They just go out and create their own synthetic option futures on indexes, or just buy their own stocks. So it's pitting those two groups, and that went into the red zone recently. So it's just one factor. You got to remember that all market analysis is a number of factors. So I'm going to carry on and just note that the month of September can be volatile, and you can see that if I kind of note this on the chart. This is the equity clock chart. I love these charts. They're very picture orientated. So you can see September is often right into October can be volatile. Like the summer itself tends to be flat, and that's why the old saying, you know, sell in May and go away. It doesn't mean you lose money over the summer. It doesn't mean you can't make money over the summer, but on average, the performance is a little bit more neutral than the rest of the year. But September definitely has a well-deserved reputation for having a little bit of negativity. It doesn't mean it happens all the time, but it's something to keep an eye open on. And I just want to point out that even though there's some negativity possibly from the seasonal perspective, the big picture, despite what the barometer is saying, despite what the seasonality is saying, the big picture is you never fight the Fed. So at the far end of this scale, I'm actually just going to move my own little pictures over, far end of the scale, you can see that the Fed has been stimulating, as we all know. Something I want to point out, that every time a Fed stimulation program ends, I marked it in red here. So every time, for example, the initial QE programs, they started in 2009 and 10, every time these programs ended, the market would sell off every single time. So even when they began talking about raising rates in 2017-18, the market went into a period of chop. So Fed, in fact, did raise 4 times in 2018, and you can see what happened there. So that's one thing to keep in mind, is that this is great. They're spending money like there's no tomorrow. Let's live for today, not for tomorrow. But the problem is that that this isn't going to continue. Do you think we're going to get another $1 trillion next year? Probably not. So when that ends, and there is a point that happens, the history shows us. I mean, this is a very strong history. Every single time these programs end, the market slows down. We have another factor that's in front of us here, and that is that the market, there's 2013, let's call it 14 to 17, where the market went up in a fairly strong, angle. And we saw that as well during the first year of the Trump presidency, where the market went up at a strong angle. Now, the similarity here, and we'll look at this in a second, is that the volatility you can see on the market in 2017 during Trump's first year was very, very low. The volatility, and then it arced off at an extreme parabolic angle. Well, you can see this market volatility has been very, very low. So it can keep going though, until you get one of these little red things, which means the Fed backs off on stimulation. So I'm not calling when that's going to happen, but I am saying that this environment, parabolic, you can see this is 25 years of history, and you can see that this just isn't sustainable. It never has been historically. So we're going to get one of these kind of periods, and the next slide kind of demonstrates that. So here's the first year of Trump's presidency, and the market was very, very low volatility. Generally, during first year president cycle, you get some strength, and Trump was very stimulative. Remember how he kept pushing Powell to stimulate, keep rates low, et cetera, et cetera. He wasn't doing fiscal stimulation. He was monetarily stimulating, but you can see it drove the market. But there's always a price to be paid after that much that low of a volatility. You can see that happened. So in 18 and 19, you got a lot of chop. Remember the end of 18, everybody will remember that. It was about a 25% sell-off, okay? Why? Because it had to take out the excess here, okay? So here we go again. I mean, I will ignore the 2020 COVID crash because that was a sort of a black swan event. But we are in another one of these parabolic low volatility periods, and they are always corrected historically. We have on top of that the election cycle. I just mentioned it. So first year, typically pretty positive. You can see that sometimes there's a bit of a pullback in the first year, and that kind of in Trump's presidency, it didn't happen until the first quarter of 18, but it's more or less was on cycle. The second year tends to be relatively flat to choppy, raising in the second half. Well, let's take a look at 2018. It was kind of flat to choppy, and then it then we did get a rally again in the first quarter of 19. The pre-election, huge returns. Oops, and that's literally what we got. And then COVID came along, and then election years can be okay too, and we certainly saw that okay in 2020. So just keeping all those factors in mind, that there's a decent chance, I think, of a market correction in the coming year. But like I said on my recent blog, where I did post this specific chart, I said, okay, this is what happens after every time you go through a period of low volatility, but I will not tell you what month it's going to happen or what week it's going to happen, because you can't. You simply can't. Even with the seasonality being maybe weak in September, that doesn't mean anything, because so long as these guys keep pushing money into the market, this is going to, really, when these periods of chop start is when QE or monetary stimulation or whatever ends. So that would be, to me, the key. Even presidential cycles aside, the main thing to watch is what the Fed's doing. But we know that so long as the market carries on in a low volatility parabolic pattern, there's very few things in life I can be assured of, but these patterns don't carry on forever. Eventually, we're going to pay the price. So with that, I'm going to pass it on to Craig and start with his first slide. Craig, I'll flip the slides as you need them.
Great. Thank you, Keith. Good morning, everyone. I'm gonna, speaking, kind of where Keith left off, he spoke about the environment that we're in. And we don't in our analysis, we look at this environment that we're in, but we're also, technically we're always looking back at the past. So these are kind of charts of where we are now and what the Federal Reserve is looking at. Their mandate is driven by inflation and by employment. So to start, then this is the inflation, and we can see in the U.S. that year over year the inflation in the U.S. is at above 5%. Well, that is something that also isn't sustainable. But in an environment like that, certainly a lot of that is a result of the bounce back from the reopening from the massive lockdowns last year. But at the same time, this is going on around the world. So while there's a debate whether this is transitory or not, this inflation, we're going to look at some other things that may provide a picture or an idea that, as we believe, it's not necessarily going to be just transitory. And with that, I think we can go to the next slide here to look into now the employment and why maybe that gives us an idea of how that it might impact inflation. This chart, you can see it just lays out how much of a spike we're seeing in the number of job openings, right, in the U.S. Now, what does that mean? It's part of it, yes, is due to COVID and the uncertainty, but we can also see that the trend here has been rising. So there are more job openings than people able to fill them or wanting to fill them. in this case, largely maybe this spike is really people not wanting to fill the jobs that are there. Why? Partly because of the uncertainty surrounding COVID, but also partly because of the continued checks that they're getting without having to go into an employment situation. So, okay, so and the next one we'll look at, this is a, we're seeing a jump back now in the number of people that have quit. So this is another element of the employment picture that we're seeing, that people are, they're unsatisfied with the environment that they're in, and they think, well, I just, I can do well, I'll move on to something else. So they see there's an opportunity, so therefore there are other jobs that they can go to, and they don't have to stay in this one. So this is another. We see the trend. It's a change from an old environment that, again, the picture says to us there's an employment picture that people are not wanting to work in the same, they've got opportunities is where it is to go somewhere else. Okay, so for the next one, now we see this is a very specific part of the employment picture, where it's restaurants and hotels employees. This is typically a very it's a 16-year high, but it's also people that get these jobs and fill them. There's been a large impact, we know, because of COVID in these industries. But so the price of labor is important in these industries. It makes a big part of the cost of restaurants and hotels is labor. These things are labor intensive. They're service industries. So to see the price, the number of people and these openings, we're going to have to pay likely more for these people to do these jobs. Well, where's that cost? And that higher labor is going to feed through to the higher prices for those services. So back to the inflation, this wage growth that we can, we expect, we've seen it, some of it, but we should expect to see more of that. And that wage inflation will not go away after a certain period of time. You're not going to be able to all of a sudden take a person's wages lower after this. They may try to reduce wages or reduce the number of employees, but still, the bigger trend here would be higher cost for labor is going to be inflationary for the longer term. All right, that's so. With that, we'll leave it there, and I think we're going to look into some questions now. Is that right, Keith?
Okay. So I'm going to start, folks, with the questions that were directly on the blog, and then if you guys have questions, you can always do a chat question, and I'll read them after and try to address at least a few of them. We don't want to do conversation questions because people might talk over each other, etc. So just use the chat box. So I'm going to start. I don't give people's last names. Sometimes, I get when I get a comment on the blogs, I can see the person's name, but I'm only going to use the first name here. So Richard said, basically asked, to paraphrase him, how do you know when you're bottoming versus making a head fake? So I'm going to actually, he gave one example, AEG, but I actually pulled up a chart that I thought was pretty illustrative. We can look at any chart really, but this will hopefully answer that question when I share this chart, and I'll be referring to, I'll be using stock charts to answer these questions as we go through this. So this is Bombardier, Canadian stock, everybody knows. So it was on a pretty nasty path. It was trading in 2018 around $5.50, and it fell to in the pennies. And then it has been on a bit of a tear lately. I mean, gosh, what a trader that has been. Like, man, I mean, if you had shorted it here and then went long here, you made a fortune on this thing, because it's, when you look at, a 20-cent stock or whatever that was, rising to $1.90, or you could have made a fortune, but of course, could have, would have, should have. So how do you know when Bombardier, for example, was bottoming? Pretty simple. This is the old rules I always use, which is higher highs, higher lows, or lower highs, lower lows equals the downtrend, and it's confirmed by the moving average. So the 200-day moving average is here, 40-week in this case, same difference. So once you see does it get a lower low, and then a follow-up lower low, and then you've got a high that's equal to the last high. So you no longer have a lower high, okay? And that in fact forms a neckline, all right? So the neckline needs to be broken. So it breaks, and you can see it did here. It's hard for me to see the price, but that was probably about 50 cents or something like that. It needed to break out. Okay, how do you avoid the head fakes that often happen? Well, here's how. I use a rule of 3, and you read my blogs, you probably know about this, but people often think, well, what I'm saying is only wait 3 days. No, what I'm saying is that's your minimum. So it's really 3 to 3. So 3 days to 3 weeks, depending on how confident you are on this breakout. Craig and I have a habit of, a policy, I should say, of legging into moves. So for example, some of you who read the blog know that we moved into China recently because it had a parabolic drop. Did we, we only put an initial 2%, like we have up to 5 or 6% when we're fully invested. Well, we did our initial third, and we're waiting to see if it does look like it's bouncing. So that's good news, because but we wait, we leg in once, we waited quite a while to make sure that bounce in this case was confirmed. It wasn't, we weren't trying to guess the bottom. So we like buying higher, and you give it a bit of time. In this case, this is a base breakout. So you give it, and so this bar right here would have been a 1 week bar. So that basically was a week. You could have bought it in here. And sometimes people will buy on a test of the neckline. So when you get a successful breakout like this, and then it tests, you can see that's done that right here. Okay, it pulled back to the neckline. Then that was a good sign. That's actually not a bad thing to see as a test. And again, I would probably, if I was looking at the stock right here, I'd probably want the confirmed test. So in other words, I'd buy on this bar or just after the week after that, and then you're in. So did you catch the bottom? No. If anybody knows how to catch the bottom, then let me know. The other thing that I look for is I want to see it move ahead of the 200-day moving average. Now, some people like crossovers, and I'm actually writing about that in the course I've been putting together. And are crossovers significant? Yeah, this is the 50 and 200-day, the 10 and 40 week, right? So everybody talks about the 50, 200-day crossovers. That's the golden cross. But I don't necessarily feel that crossovers are necessary. What I do like is to confirm an uptrend is that it's above the moving average, the 200-day. All right. But the most important thing is that it breaks this neckline with conviction. So what does conviction mean? More than 3 days. Okay. So hopefully that answers that question. I'll answer a couple of them, and then there's a couple that Craig is going to be addressing. So maybe I'll answer the first 3. So the next one was from Diane. This is an easy one. What sectors on a seasonal basis are best to the end of the year? And will I be investing in these? So the answer is yes, we do follow the seasonals, but we pay attention to the charts. It's really important that we see a favorable chart. We don't just buy it because it's in season. So that's really important. It's kind of a shopping list idea for us, that if technology, which happens to be one of the sectors that does very well from October on, okay, that's the tradition. But if technology stocks aren't looking good, we won't buy them. They typically do, though. This time, they're a good point to buy sometime around this time of the year. You've seen that really over the past 6-8 months, a lot of the tech stocks have kind of gone sideways. Not all of them, but many of the big ones. So technology, consumer discretionaries. These are the 2 basics. You can almost rotate through these. In fact, Brooke Thackeray in his book talks about it. If you just rotated these 2 sectors every year, you bought the staples in the summer and then you sold them, and you bought the discretionaries in the winter, you'd outperform the market by a massive degree. And I do agree with that. It does tend to work more often than not. So we do tend to look at the discretionaries at this time of the year. Industrials often do well over the winter, the whole winter, in fact, not just until the year end. Now, financials are something that we are currently heavy into, even though we held them from last fall. Why? Because they were a value play. And if you remember, if you follow the blog regularly, you know that I was pounding the table about value, and Craig and I moved aggressively into the value areas, and banks were one of those areas. So we'd made a good chunk of money on the financials. And now, interestingly enough, even though they've kind of been flat over the summer, now you're just entering into their seasonal period. They tend to do very well from around now, basically September to October, into the end of the year. So I might expect more upside on the financials from both their technical profile and their seasonals. So there's Diane's question answered, and I'll do one more, and then Craig's going to answer one. Ted asked about lithium battery stocks or ETFs and uranium. So thanks to another reader who actually answered Ted's question for me, and also posted a question of his own. The lithium battery you can buy through a couple of ETFs. It's LIT and BATT. If we want, we can look at the ticker. I'll just pull up one of them. I'll just pull up BATT just for fun. And you can see it's a relatively new chart. And you did see the problem with these kind of charts is that there's not a lot of history to them. So you have to take that into consideration. But there was a neckline breakout here this is again only a couple of years old. So there was a neckline breakout, a little bit of a test of that neckline, came close enough, and then it looks to be okay. So from a very limited amount of data on a chart, I can say that it looks okay. So that's two ways to play the battery or lithium arena. Now, he asked about uranium. You can buy uranium as, I think it's just U on Toronto, okay? And no, I'm wrong about that. Craig, do you remember what the ticker is for just uranium participation notes? I thought it was U.
Yeah, I think U.
It's not. Oh well, doesn't matter. So I will disclose the stock I'm going to talk about now. We own a position in. Kind of happy that we own a position in it right now because it's done pretty good lately. It's chemical, so we own the stock. So personally, professionally, family, all that stuff. So take that into consideration when we talk about it. But we bought it because it did a giant breakout here. You can see it was consolidating for a zillion years, and then it broke out. Classic, breakout. I like the longer the base, the greater the case. There's a little ditty to try to remember. This was a nice long base where it just couldn't crack $16 or so. It did a test right there, and off it went. And we were buying it in here. Okay, nice looking chart. We think that because of this base, it's got lots and lots of upside. There's fundamental reasons. Craig, do you want to touch on the fundamental side of the uranium play?
Sure.
Like the green movement and all that junk.
Right, and that's really where it comes down to. We see the price of other fossil fuels rising, and with that, there's a shift to greener and to cleaner energy. Well, that shift is really, there's a big part of it that is dependent on nuclear, and for nuclear you need uranium, and so we are all aware of disasters that have happened, and that did cause a movement away from nuclear energy, but now we see that coming back, and there's talk that some of these shifts that has taken place in the past, where countries were going to reduce their nuclear energy capacity, are now potentially changing course. Well, if that takes place, it's expected that the uranium market will really have to adjust, and though that adjustment will cause prices to go higher, because it's the capital commitment and the capital required and the time to change into to set up new facilities for uranium are long. They take a long time to do it. So the prices are expected that if there's any shift or there's any, it's a tight market is what we're saying. It's a tight market that if the demand really picks up in there, you're going to see prices move significantly.
Okay. And by the way, the other part of Ted's question is there a seasonality to uranium? I'm just going to say it's a commodity, and commodities, most of the metals do actually okay over the winter. Oil actually doesn't, but metals materials do. So it's, I don't know how you want to classify it. It's a commodity. It might do okay. I'm paying less attention to this is not a seasonal play at all. This is a pure technical play. Okay. So maybe I'll do one more, and then Craig will cover one actually on one of our favorite subjects, which is commodities. But so this is a fairly easy question. Is the 200-day, this is from Tamar, is the 200-day still the line for determining to stay in a stock? Remember, my rule of thumb is that it's not just a break of the 200-day. So if we want to look at any stock, you'll see that it's a break of the 200-day and a break of the past low. So that's when I know that the uptrend is over, or even the consolidation is breaking down. So the 200-day by itself is not the go-to line. It's actually a confirmation line for me. Price trumps all. Price pattern is what I'm interested in. The 200-day moving average is important, but you can see when markets are moving sideways, it's actually meaningless. This red line is the 200-day 40-week, and it's meaningless. So it's really just, yes, it's a trend indicator, and I use it in the barometer. Is the market ahead of the 200-day? Yes, then it's in an uptrend. That's one of the binary questions. I also use the 50-day in the barometer, but it's not what drives us to make a trade. It's price that drives us to make a trade. Okay, so that was a fairly easy one. Craig, why don't you go into Francisco's question, which was, and I'll just read the question. Basically, he's asking what, to kind of differentiate between commodities and the producers, and why they sometimes differ. So Craig, you can cover that.
Okay, specifically, the question relates to gold and the ETF gold, and how we look that ETF. There's some ETFs are the pure commodity based, like GLD. This is just raw, the commodity, right? And the question then would be, how does that differ from an equity that invests in companies that are exposed and produce these commodities? So we'll look at that, and now compare that to a GDX. And this is a US denominated. So it's a basket that is reflective of the Amex Gold Miners Index.
Do you want me to do put them both in the same chart and do a correlation or anything, Craig?
Sure, let's do that.
All right, so so what we've got here is now this is GDX versus the S&P. So I'm doing GDX versus
GLD.
Yeah, GLD. Oops. Okay. GLD. GLD. So now we are looking at the comparison of GDX, the stocks, to the ETF that represents the price of gold, right? And so this line here is the correlation. You can see it is most of the time positively correlated. So 1.0 is 100% correlated. They move together. But on occasion, you can see that they're not so correlated. And this is the comparative strength between the two. But so we kind of just the red line here is gold itself, like the bullion, and the black line is the producers. You can see, for example, here you had a time when the producers fell like a rock. Excuse me, fell like a gold rock, and gold itself didn't fall nearly on a percentage point as much, and you can see the correlation here went to near zero at that point. Okay, so you can see it's most of the time correlated, but not always. So Craig, you could,
and then the reason then we would see that divergent, that shying away from the correlation would be because there are just so many factors, specific stock risk, particularly in the ones that are they're mining this commodity, and they've got all those operational risks that they're exposed to, political risk as well in some of the places where these companies are mining gold. It's if there's a lot more political risk, let's say in Zambia or South Africa, than there would be in Mexico or the United States. So that that plays significantly into the price of those stocks as well. In a cycle where maybe gold hasn't been doing well for a long time, and now it turns around, that the commodity, the price of that commodity has a huge impact on the company itself. If the commodity has been depressed for a long period of time, and the company then might be forced to have taken on a lot of debt and really stretch their capital structure, now when the price is expected to move, investors will be jumping in to try and foresee and to try and get into the company at a point where you're going to see a lot of leverage by that higher price, and the company will clean itself up in those good times, and that's where you would see that the real move maybe ahead for the companies that are exposed, as opposed to the straight commodity.
Right, and you can see that right now. Actually, the red line again is gold bullion. The black line is the producers. You can see the black line is diverging negatively. It's gone down versus bullion, but there'll be some catch up to play. So that's why the correlation has fallen a little bit lately. So this is what Craig is saying, is that sometimes you'll see the price of gold do something, and then the producers may move sharply to catch up, or in the case of a drop, to pitch down. So that hopefully that covers that question, and that was from Francisco. So we'll go on to the next question, which is somebody was asking about. Paul was asking about. He was asking me basically, okay, look, if you've got a stock like Royal Bank, and Royal Bank is a stock that's very prevalent on the TSX. Like the TSX is 35, or I think it's 35% financials, right? That does include the insurance companies. But now you've got the biggest sector on the TSX. The second biggest is energy at 20%. So Royal Bank is going to follow the index or not, is what he's asking. So should he even bother buying Royal Bank by itself, because it's going to move the same as the index? And so this is an easy one to answer. Definitely there's very different. I'm just going to go back to a clean view here. So if I look at Royal Bank, okay, that's it does have some similarity, but now we can do a correlation. I'm going to do a correlation with the TSX, but TSX. Okay. So you can see, yes, it's often correlated, but at times it's not. So in fact, it frequently doesn't act exactly like the TSX. So the TSX being the red line and Royal Bank being the black line. So is it worth buying Royal Bank and by itself if you were interested in that stock versus just buying the index? I would say, yeah, because there's going to be periods of time where the banks will outperform. And in fact, there is seasonal periods. And that one of those seasonal periods is upon us right now. I was mentioning that the financials tend to do better in the last quarter of any given year from a seasonal perspective. So if I was looking at buying Royal Bank, by the way, we prefer the US banks by a long shot. We do have one Canadian bank, but we're much heavier into US banks right now. There's better value there. The charts look a little bit better. But whatever the case, the financials tend to move in the last quarter of the year. So would I buy an index today or would I buy Royal Bank today? I'd probably having a gun to my head, I'd take the Royal Bank right now. So there is high correlation. So Paul's question was valid, but at times it's not so highly correlated, and depending on when you're buying, I guess would be my answer to that. So hopefully that covers that question. I'll cover one more, and then Craig will cover something on the whole green movement in a minute from a reader. All right, so this is, I think, one of my favorite questions. I just love this question. And I covered this a lot in the past, and I've covered this in the course that I'm designing right now. And Bill is asking, why not, can you show us how to use charts to stop out of a position? And why not just use a mechanical stop? And I love that question. So I'm just going to pull up, I'm going to go to a clean view. And let's even just take a look at, I'm not going to use Royal Bank because it's not volatile, but I'm going to use good old General Electric, which is a favorite topic of ours because we've traded it a few times. So this is a nice choppy chart. And so, it will give us beautiful examples of how to buy and sell and why you shouldn't sometimes use a mechanical stop. You should use only a mental stop. So this is a chart that you can see it was in an uptrend. It's following all the rules. Now, unfortunately, the moving averages I've got to correct here. I'm going to take off this one and just use, so the moving averages here is a 200-day now. It's a 10 month. This is a monthly chart. But you can see higher highs, higher lows, boom, that breaks. We get some sort of a neckline break, a lower low, a rebound to the neckline, and off it goes. So it would have been a great place to sell it here. Okay. Why wouldn't you use a mechanical stop? Because sometimes you get these kind of movements here and here, like this is a good one, or here, like say you were using that 200-day moving average and you were saying, okay, if it breaks the 200-day, I'm out. Well, you would have been out and it would have gone right back up again. So you have to be careful. Sometimes there are periods of time where the market consolidates. And in fact, here we had a slightly lower low. So you had to have some sort of a rule. In this case, you waited a month or so and you said, okay, well, I'll look at this last low and call that support. So you could have, in this case right here, you said, well, here's my support line, which happens to be $160. If it breaks $160, I want out. Well, look what happened here. That stock spiked, obviously for 1 week, possibly even 1 day only, to $130. Okay, you would have been whipped out and off it went higher. All right. So what my belief is that you're better off in most cases to use a mental stop saying, hey, this support level in this case, and Craig and I did trade this year. So we were in during this period and we got out and we noticed the neckline break at around $200. It broke the 200-day, this is a 10 month here, which is a pretty similar time frame. And we let it go for a couple of weeks and then we sold it. And we've actually traded it in the aggressive account here a couple of times because it's been very volatile. It's trying to base right now, but you can see it hasn't broken out of the base. So the answer as to why you wouldn't use a mechanical stop, because these things happen where you get these big spikes and it can be kind of ugly. This was a big spike, like this low was really not taken out, but this spike took it out. So you would have just been whipped out of GE right here. and missed out on all this upside if you had a mechanical stop in place. All right. So that's the reason why we don't use them. We use our judgment, and we use a day count. Like we count at least 3 days for a break before we take action, because sometimes you get these spikes and tails, they're called. So hopefully that answers the question. So Craig, I've only got one more question, but I want you to maybe address the green movement. And I think it was Garth that asked about the fossil fuels to green and all that stuff. So why don't you take it?
Let me just, I'll go through the question. Garth asks, assuming that Western industrial economies cannot completely switch from fossil fuels to green, and that developing economies are committed to fossil fuels to achieve what the West has in terms of standard of living and scientific development, do traditional energy investments have a bright future? There's no doubt that there is a transition that seems to be inevitable, that there is both developed and developing nations are moving to a more less harmful or less impactful energy push, the green movement. But it's the speed with which this takes place that we're gonna, that is going to impact the fossil fuels themselves. And that speed is not going to be a straight line. We've seen, there's been great global initiatives that with often great and very ambitious, but their execution is not straightforward. They put out these 10, 15, 20-year time horizons, but in the midst of that, things change, and that dynamic is played out often in the fossil fuels and the price of the commodities. Not so far. There's no reason to believe that that's going to change. So when you have a commitment to go and reduce carbon, yes, it's likely that's the direction it's going to take, but it won't be a straight line. And in that, we're going to see the commodity price volatility. And there has been, we can look at Canada specifically, and the fact that so much capital has been taken out of the energy sector, and that capital meaning for new infrastructure. In that shift that's taken place for years. Well, that's not coming back. So all of a sudden you have an increase in demand, and you can't bring on the supply fast enough to support it. That is true in not just oil, but gas as well. And there's other commodities that this will also continues to impact, whether it's copper, whether it's iron ore. All these are impacted by the greater infrastructure that's needed to build your turbines, your wind turbines, to build your solar your solar installations. So I don't think this push and global initiative for a greener environment spells the end for energy investments straight away. So in that, there's opportunity, and there will continue to be opportunity as we work through these global initiatives.
Okay, well, that's as people I guess get a little bit excited about themes, and I spent a bit of time talking about that in my new book. You get tied up in what the crowd is talking about. So this is the last question we're going to address from the blog, was from Andy, and this is Andy helped answer one of the other readers' questions about the lithium. So this is the famous Andy, and he says, how do you screen looking for ideas? It was, he says, I very much appreciate what you do. He says, how do you find sectors that are showing signs of interest? In that vein, what do you suggest in trying to screen for interesting sectors and stocks themselves? So I'll give a few ideas. Like right off the bat, I will recommend that everybody listening to this right now, buy a copy of Thackeray's Guide. And the reason I like the Thackeray's Guide is because in book format, you can basically, it's like a calendar, and you flip through it. If it's January, he basically tells you what's going to happen, what you should be looking at, what you should be maybe selling from a seasonal perspective. All right. So it's kind of a day-by-day calendar that you can flip through. And if you buy one of his books, they tend to repeat themselves. I would say that you buy his new book every couple, 3 years, and you will have in front of you an idea book filled with all kinds of great examples of what sectors you should be looking at from a seasonal perspective. You can also, and I'm going to now share the screen again. We're going to look at something that's stock charts. Now, sorry, where did my, there it is. Okay. So stock charts is not the only program out there. There's TC2000, but I use stock charts, and I usually recommend it to retail investors, meaning you guys. Why? Because it's pretty easy to use. Like TC2000 is more complicated. It's got programming ability. It's definitely a more sophisticated layout, but for most people, stock charts is a good tool. So if you go under, and I think it's like $300 or $400 a year for the basic subscription, and it gives you tons of back data. So they offer something called perf charts. Here it is. So what you can do is they have different predefined groups, but when we talk about sectors, we can go to the S&P sectors, and you can look at any time period. So if you want to look over the past 200 days, I like looking at about the past month or so. So that brings us to actually about 22 days if you subtract weekends. All right. So over the past, it's just really hard to get that. Actually, you can type it in here. You can go 22 days. So here we go. So this is 22 days. Past month, what's starting to see some rotation, and you can move this back different dates, and you can slide and see what's kind of been happening. And I like to see when there's rotation. So obviously, for example, sorry, I'm pointing at you. The materials were out of favor, but as we move forward, materials have become in favor. So there's materials are starting to get a bid. You see that? It's the black line there. It's way out of favor. I move it forward, and materials are starting to get a bid. Okay, maybe not so much past couple of days, but you can see using these, it gives me some perspective on what's happening right now. It's not the only thing I recommend looking at, but that is one area you can look at, is to see where the money's going. So that's one area. Now, as far as, so seasonality and sector rotation charts like this are good, and you can look over any time frame you want. You can expand this to past 2 months, whatever works. You'll start to get a feel for things as you rotate forward. But for individual names, for a retail investor like Craig and I, we have like a $20,000 budget for research that we pay for, independent research. So I don't think most of you guys listening to this are going to be buying $20,000 worth of research a year. But I think that retail investors can get a lot of value out of, if you go to stockchase.com, they basically just print the BNN picks every day. So there's two portfolio managers on BNN every day. I've done in the past. Technical analysts can't go on the show right now, and we need our telus readers, as you see with my charts. So they haven't had any of us technical people on, but there's a source of 6 new ideas a day you can look at. Because I know, as a portfolio manager who has had 2 decades, literally since it was Rob TV on BNN, that I do like to give 3 pretty good picks. So you don't want to, because they always have you on the show in a future date, and you got to look at your past picks. So you don't want to have like 3 losers that everybody's going, well, I won't listen to that guy anymore. So I will say that it's typically the portfolio managers trying to put their best foot forward. So they are pretty qualified ideas, but you got to remember, these people are on the show right now in particular are fundamental people. So what I would recommend is that you have to use the charts, because some of these ideas, I look at the charts and I'm going, good grief, they're buying at a very solid ceiling of resistance, or it's in a downtrend. I mean, you have to be careful, but there's still they've done some research to pick those ideas. So that can be one area that you can look, but you do have to do your own screening. Another source is I write for Investors Digest as well as a few other publications, but I think Investors Digest is a very good source because it's got superstar brilliant people like me writing for it, but also it's got a section at the back of traditional bank analysts, and they're putting through some of their best ideas, same ideas the BNN. They will do a few stocks that their firm has recently recommended because they're trying to attract people to their firms. So it's Investors Digest is pretty cheap to subscribe to, and it's got some great ideas. There are other programs you can use to find ideas. One of my retail contacts, he's not a client, but he and I talk a lot. He loves technical analysis, and he's a do-it-yourself investor, and he uses something called Trade Miner. I actually bought a subscription to it just for fun. I didn't find it was working for me, but he gets great value out of it. You can kind of have it pre-screened seasonal stuff on an individual stock basis. It only covers US stocks, but it's cheap. Okay, it's called Trade Miner. And then there's other programs out there that will offer you ideas. So that's really, I'm trying to think of a point from you as a at-home retail investor. You're not able to buy the research Craig and I do. We do get really, really good ideas from the research we use. For example, the Cameco idea came from one of our research sources that we pay for. And I thought that idea alone has probably given us the $7,000 or $8,000 that we pay per year, in value from it. So you can't afford that stuff, but certainly BNN and all those ideas, they're just a way of screening. But do use your technicals, because just because some portfolio manager says it's good, it doesn't mean they're looking at the trend. There is also, you can use stock charts, and I don't use it in this way, but there is, and so I won't bring you through an exercise on this, but I hired a guy a while ago, and he basically was screening for breakout candidates, and he was very good at it. So he had a little program, he ran through stock charts, and he would find stocks that have been consolidating breakouts, because that's the kind of, I told him, this is what I like to look for. So he designed a program on stock charts, and he would find some okay breakouts here and there. So using this scan. So stock charts does offer a scanning tool. And if you want really good scanning, you can, and you're a bit more sophisticated, TC2000 is the better tool. But they're both, again, stock charts is more user-friendly, I'm going to call it. So that's probably the other thing I would maybe look for is on stock charts, program it to look for 200-day moving average breakouts. So that can often indicate a breakout from a base. So that's some ideas, hopefully, Andy, for you. So, but I'll be covering more of that, because I'm actually trying to dig into sources for that educational course that I'm creating, because I can't think as an institutional investor here when I do this course. So I can't talk about, oh yeah, just call Market Desk. They're only $8,000 a year, and you can get all these wonderful ideas. It's probably, I want to find ideas where maybe a retail investor might spend a few $100 a year and get really quality investment ideas. So for now, that's what I'll give you. So if there's any questions right now, please type them on the bottom of your screen. You'll find a thing that says chat. You can type those now. If you don't have any questions, I'll wait a couple minutes. If I don't see any questions, we'll kind of wrap it up. Craig, was there anything you wanted to finish up in mentioning about our direction and anything like that?
There's our direction. We still, as you've probably gleaned from the conversation today, we're still very much in a commodity environment where we think there's opportunity there for many of the reasons that we discussed today. But to bear in mind that the way we look at things is we try as much as possible not be thematic. So if that trend changes and the environment changes, we're going to recognize that and move on to our next trade.
Okay. All right. Well, I don't see any questions in the chat box. So folks, thank you very much for participating. And this is recorded. So certainly you can watch it again if you want, or send it to a friend or whatever you wish, because we'll have a link and we'll send it out to everybody. And thanks for attending. We'll keep on doing the blogs and videos for you. And anytime you have a question, post the questions on my comment section in the blog. Thanks for watching.